All right, so we already talked about the ETFs. We already talked about stocks. Just to recap, ETFs is where you should start. Auto deposit your money. Check on it every, month, every year or so. Just think of it like a 401k. Set it up for auto deposit. Put it right into the S&P 500 or QQQ. Once you get good with that, learn your stocks. Start with what you wear, what you buy every day. So if you like Apple iPhones, start with Apple. If you play computers a lot, look into Intel, AMD, NVIDIA. Put them on auto deposit. Check up on them every now and then. Forget about it. Check it in 10 years. So long term to me means 10 years or longer. Everything else, have a plan for it. If you want something short term, it's either 10 years or a house, whatever comes first as far as what you can buy with your account. So usually you can get a house within 3 years on auto deposit, $100 a month, probably get you a nice $20,000 down payment. So now high yield ETFs, it's a different strategy for these, and they could be hit and miss. Usually they always pay for themselves, but when it comes to these, let me see if I can show you. So I still got this one up, like I was saying in the last video, but Misty, a lot of people like this one. A lot of people like this one too. Now they all serve their purpose, but as you can see, ULTY, which is the orange, if you bought it a year ago, you'll be down 45%, right? So if you put $100 in there, you would have lost $45 and 80 or sorry, yeah, $45.85, almost half. Now, the good thing about it is, like I say, they always pay for themselves. So if you think about the dividends that you got, so you'll be up 29.4%. As far as if you reinvest everything, you'll be up basically 30%. I'm about to sneeze again. Dang. At least I thought I was, but hold on. But like I was saying, but ULTY, a lot of people like this one. You'll be up 30%. So what I was going to show you was, again, hypothetically. So last time we did Misty, so a year from today ago, if you reinvest it, you would have made 40%. Now, what I do, like I told you, is I don't reinvest it. So I still would be up 26%, but that's because they're considering the, $2,633 that I have in cash. And then luckily, so I mean, we had some price appreciation, I guess, but or not price appreciation. Yeah, this is just considering my cash. So you would have got in at $10. Now your cash would have been sitting, 50% less basically. And you'll have the equivalent in cash. But I like to take this and put it into something like the S&P 500 or really QQQI because that pays you monthly. So this one pays you weekly. And then let me show you this real quick. QQQI. So let's say you just had these two. You take your dividends from here and then put them in here. And then that'll give you an extra 20% on top of that. Not extra, but you average about 20% a year still doing this. But the dollar amount that you have invested won't go down due to NAV erosion. So essentially, if you invested the $1,000, you'll still have that $1,000 plus, the cash that you made because QQQI is basically the NASDAQ. ULTY, it does have a bunch of underlying stocks that are really great in it. But again, because they have to pay you out so much, they take that from their share price. So that's why the share price mainly goes down, even though they give you the equivalent back in cash. So you wouldn't want to take that cash and just start living off of it because your money's slowly going down. And if you're spending the cash, it's not recuperating itself. So you want to put at least, I would say, put all of it into like QQQI. And then the monthly dividends you get from QQQI, you can split that up and reinvest half and put half in your pocket, however you want to do it. But I do got another example I could show you. Again with my account. So this account's only 1 month old and it's pretty much stayed around $100. Today, NASDAQ hit all-time high. So of course that reflects in my account, even though it says like I'm technically down half a percent, 0.64%. I'm still up. And you can see the price pretty much stayed around $1 or $2 difference from $100. And if I go to activity, I've only got paid dividends from one, which is my weekly payer. So QQQI and then BTCI and CRF, those are monthlies. So by the next video, I should have gotten them, which I'll do it at the end of September. And then again, if I go to performance, so net deposit $100, haven't withdrawn anything. And then investment income, I've made $2.88 so far. So really almost 3%, which, that's pretty much 40% a year. And that's with the price appreciation included. So that's without the 288 is just straight dividends. So if my price just stays around $100, stays pretty much even because how I got it allocated, I'll still have an extra $40, $33 around there into this account in cash by the end of the year, or a year from when I started. If price goes down, I'll still have the cash, but we'll see. I'll do updates and I'll just reinvest the cash that I get. So I got $95 invested, sitting on $6 in cash. Basically had $5 in cash before I got the $2.88. So this is just with $100 just to show you. So if we go to my fund calculator again, which I kind of already had set up from the last video, start with $100, probably expect 30% a year, reinvest it every month. And then I would say contribute $100. Obviously, the more the better. But there you go. 34% increase. You contributed $1,200. It made an extra 20% in free money. Now, if you wanted to get a house, I would say start with more. Like starting amount should be $1,500. That's $10,000. That's almost close to a $350,000 house. So this gets you around a $250,000 place. But you get the idea. I'll show you how to make around 45%. You do that, that's $13,000. But you're starting to get the idea, even with a smaller amount, and then contribute $100 a month. So if we go to this one, so here's what they're invested in. Go to diversification, so you can see how I set this one up. So this is with $1,000. Put 50% into MSTW, which pays weekly, and then almost split them up evenly between the other three. But CRF and QQQI, those would be the ones that I'll reinvest the gains from BTCI and MSTW into for the most part. And then when these are really down, on down days, I'll reinvest the money into those. But let's go to this calendar. So let's just go to October. So essentially think of it as you'll make an extra $38. So you get a paycheck every Tuesday from the weekly payer. And then for the monthly payer, it's the end of the Friday. So the last 2 weeks, BTCI, QQQI, and then the last week Friday, CRF. And that's how it'll be every month. So if we go to the next month, November, same thing. Every Tuesday, and then the last weeks of the month, that Friday. So I don't think this is too far off from what I just showed you in my Fidelity account. But if you had $1,000, $488 at the end of the month, or 47%, I'll say expect around 40% minimum. And of course, it can be more based off these two and their price appreciation. So, it's easy to do math with 40%. Just put in the calculator like we was done before. You put 40% in here. Oops. 40% in here. Let's say you started with $1,000. That's 400,000. That's $400 a month. $400 a year. Sorry. Times. Let's just go with 3 years, and you do $100 a month. You have a $10,000 account. Simple as that. And remember, these are supposed to be long term, so it's either a house or 10 years. So in 3 years, you kind of got a deposit for a house, which I'll say double this up. So that means 6 years. You have $40,000. That's more than enough for a house, probably even a $500,000 house, for sure, a $350,000 house. So think about what you was doing in the last 6 years and what you could have been doing with, $1,000 and an extra $100 a month. And put this on auto deposit. Think of it like a 401k, put on auto deposit and just have it deposit right into those shares. Now, these are the ones I chose. Now, to find them, I like this site. Let me see if I can bring it up. 1 second. So here's one of my favorite ones. It was made by another YouTuber, which hopefully I can remember her name by the time I upload this. But either way, it's called Yieldmite. And what it shows you is, let's say you start with $100. Here's the ones that's coming up for next week. So, do your research on them. I can tell you right now, this one's based off Tesla. This one's based off NVIDIA. This one's based off Coinbase. I think this one might be Microsoft. And you can see you'll get paid 88 cents a week, which is 45% a year, 33% a year, 26% a year. And what I like to do is, like, you take this TSII, come to Seeking Alpha, put TSII in there. Oh, this one just started. So it's only a month old. So you'll be up 20% just because on how Tesla's been doing in the past month. And then you still get paid weekly on top of that. But as you can see with some of them, if it's not based off a single asset, like if I was to like add another one, it'll be ones like these where it's only based off one company, because I already got one that has a basket of companies in it, which is QQQI. So the other ones, like if I like Robinhood, I know one of them is HOOW, I think. Yeah. I would do HOOW. So this one's about a month old too. So this one you get paid weekly. And let me see in the past month what you'd be at. Yeah, so still the same thing. In the past month, well, you'll be up 18% already. And that's because you get paid weekly, and Robinhood has been going crazy over the past month, as you can see right here. So let's say you like Microsoft. I already showed you one that has the Microsoft, which is this one. And you can play with the settings over here and you just take the ticker, put in Seeking Alpha, and then see how it's performed. You can even go to, well, this is this one. I just Googled this. But EFTdatabase.com. And then you just type it in. But top 100 highest paid dividend ETFs. And you can just go through them. Still the same one. See ULTY, another Tesla one, another Coinbase one. And you just click on them, like TSLY. And you can read up on it, learn about it. This is the boring part. Don't just invest because somebody told you. But learn how to do it for yourself. I already kind of showed you what they are. Kind of gave you an insight of what it looks like based off my portfolio. So here's my positions again. As soon as it comes up. Not sure what's going on. It might be getting updated. But still my same account, So BTCI, which is Bitcoin, CRF, which is Cornerstone, MSTW, which is, MSTR is Michael Saylor, QQQI, which is NASDAQ, and then cash. And then with Fidelity, they show you. I guess one thing I didn't mention in this one or the past videos, you do get margin. I have it turned off right now, but I think there's a portion that could show me. No, I don't have margin turned off. Yeah, see, margin buying power, another $68, which technically I don't even know if they'll let me use it because I could have sworn you need at least $2,000 to even use margin. But margin's a whole nother different story. But it basically doubles your account that you have in here. And then even with that, I'll use half of that margin. So let's say I did want to use this, I'll only use up to like $30 of it and have a $130 account. But eventually I'll use the margin on here because I know that's why I got it turned on. Because with the options to do spreads, you need to have margin. And I think, is that the next one? What's the next one? Yeah, the next one's options anyway. So when we talk more into about the options, you need margin for that anyway. So if I remember, I'll bring up margin. But if I don't, margin just doubles the account that you have in there. And then even with that, I wouldn't go over more than 40 to 50% of the margin that they give you, because you never know. The market can drop down crazy. You want to have that cash on hand so you don't get margin called. That's pretty much it as far as for high yields. So with high yields, I like them a lot. It's one of my favorite ones to invest in, more so than ETFs and stocks. But as far as riskiest, it's still on the safe end just because it's another company, and usually what they're doing is what you're going to learn in options, where they're just selling cash secure puts and covered calls, and they collect the premium, and then they share the collected premium with you via the dividend that you get from you investing into their ETF fund. So once you learn how to do what they're doing, then ideally you don't have to use the high yield ETFs, and you can just stick with you doing it from the options and then taking the premiums that you learn and buying stocks with it. Because the stocks, they don't pay you monthly, of course, but they have a shit ton of more growth. So you can go from options to stocks, or take your options premiums, put into crypto, or put into crypto from here. One thing I didn't put on here was real estate, because for obvious reasons, we're trying to use this to build up to buy a house if you don't already have one, or to start investing into homes. But homes, they have their own, downfalls, I guess. You still got to deal with tenants and repairs, which is kind of like dealing with, the price of stocks when they go down. But, less maintenance. You just got to wait for the stock price to go up and you get your money back. When you fix your toilet, you don't necessarily get that money back unless you want to be technical and say, well, I got it back with my rent. Sure. But at least we're here, if the stock recovers, which, like things like Apple does, you'll get the price appreciation plus you buying more when it goes down, and plus the amount that you had in there didn't go anywhere. So that's the biggest difference. But on to the next one with options. That one's going to be more in detail because, again, I like them a lot. I do have a paper account where I started doing spreads just because I wanted to see what could I get doing spreads safely, because the only spreads I know how to do is when I'm trying to make some good money right away. And I was trying to work on a strategy to where you can use spreads the same way you'll do cash secure puts or a poor man's cover call, which, let me put that on there so I remember. So, but that's on options, and we're working our way down. But so far, you already learned how to make up to 50 to 40%. Stocks, you can make those gains, but you don't get the satisfaction of getting cash. You would have to go take a loan out if you didn't want to sell your stocks. At least with the high yield ETFs, you can still get a loan based off your portfolio. And on top of that, you can use your dividends to pay off that loan, especially once it's more stable. Now you can really talk about like, hey, getting a personal loan, as long as that interest rate on a personal loan is at least half of what you're making. So if monthly or yearly, you've already been doing this 2 years or 3 years, you're going to collect minimum 30%. Whatever loan you get, just keep it at 15% or lower. And let's say you got a $10,000, you can throw that $10,000 into your account and just use your dividends to pay off that loan. Same thing. I mean, there's a bunch of strategies once you actually got some money working for you.